guys, welcome back to my channel. I'm your host Miss KK and this is The Wave, your weekly show on all things money. On this show, we get to dissect topics related to personal, family and business finances, and our hope is that by the time we get to the end of this series, you'll be better equipped to make sound financial decisions. If you are new here, thank you very much for passing by and welcome. Please consider clicking the subscription button so you can be notified every time we upload a new video. And if you are already a subscriber, thank you so much for your continued interaction in the comment below and for viewing all the time. We're getting to the end of our business series, at least part one of that series, where we've been dissecting or where we've been discussing some of the topics that a lot of young entrepreneurship or rather small entrepreneurs are facing. We've spoken about the two top reasons why your business could be failing. Then we explored other further reasons why your businesses may be failing. We looked a little bit into the agent versus principal concept, and we also looked at some of the elements of the cash working capital management. And lastly, today we're going to be wrapping up that discussion with the concept of cash flow management and cash flow forecast. So a lot of you guys, if you've ever applied for funding for your business, you realize the bank or the learning institution would typically ask you for what is called a personal balance sheet, a cash flow forecast, a budget, etc. And really all they're trying to assess here before they lend money to you is they're trying to decide whether you will be able to honor your commitment should they lend the funds to you. Normally, a lot of people don't really understand the concept of cash flow projections or budget, and they tend to just outsource this process to someone that supposedly does business plans, and they'll pay this person to come up with this cash flow projection. This is very risky, although it's a common practice, because the person you're outsourcing that business plan to or that cash flow projection preparation to could not have the industry knowledge that we already spoke about, which is the first common mistake that a lot of young entrepreneurs make. Number one, you yourself don't understand the industry, and then on top of that, you're outsourcing the critical part of that business processes to someone else that you are paying to do the work for you. So typically what you want to is you can outsource this part of the process to someone else, but you need to be engaged and involved in that in that conversation. So ultimately, when we look at the cash flow projection, really the bank is trying to understand that, do you really understand the money that's going to flow in your business at a particular point in time over the certain period of time that they are asking you? The duration of your cash flow projection will be determined by the duration of the loan that you're asking for. So if you are looking for short-term financing, you're likely to be asked for a shorter cash flow projection, but if you are looking for long-term financing, you're likely to be asked for a longer cash flow projection. So some of the key things that you need to consider when determining the inflow or the sales projection in your business is, what sort of revenue streams do you have? Do you have one revenue streams or do you have multiple streams? And are you able to disaggregate the streams in order to give more information to the users of this cash flow projection? Typical example, let's take a car dealer for example. They provide sales of cars, they provide sales of parts, they provide warranties and maintenance plan, and they also do other ad hoc, labor jobs for this, for the cars that are brought in their service. So if one is actually doing a projection for a car dealer and you want to give as much details as you can, you're essentially supposed to have these 4 revenue streams separately so that you can project how much each of this revenue stream is going to grow over the period that you're trying to project, because the sales of cars won't be growing at the same rate as the sales of the parts, and so will the sale of the service won't be growing at the same rate as the labor sales that you're going to be getting. So technically that's what we are trying to get. So number one is disaggregating those revenue streams. Number 2 is finding the drivers behind those revenue streams. And number 3 really is looking at the growth factor. The growth factor will be determined on what your plans are. So all else remaining constant, your sales is likely to grow with inflation, because you're going to be adjusting hopefully your prices over time, because the prices of the suppliers will be adjusted over time to reflect the cost of the components, so as your selling price needs to respond to that cost adjustment by the suppliers. But you could also have a growth, organic growth component in your projection, in the sense that you're either opening up new branches, or if you're opening up new branches, of course, it's going to result in new revenue, or maybe you are expanding your existing business such that you can afford to sell more cars or more parts from the existing warehouse. That is also likely to affect your revenue growth. Then moving on to the other element, which is the outflow of your cash. There you're really looking at the operational costs from mainly two buckets. You want your once-off costs, then you want your recurring costs. Your once-off costs are really costs that you're going to be incurring upfront. Say you want to get a loan to start a warehouse. Obviously, upfront you need to have highly intensive capital cost to set up the warehouse. You're going to have material for the warehouse, you're going to have the equipment that are going to be used in the warehouse, you're going to have some consultation fees for the engineers and everyone that's going to be involved in making sure that that facility is structurally sound, etc. So those costs are likely to be incurred in year one. But going over time, you're only likely to see your recurring costs, which will be now the cost of the sales that you are making. So if you are selling cars, the cost of those cars to the supplier. If you are selling parts, the same thing will follow. And in the same manner, if you're going to be disaggregating your revenue streams, you also want to disaggregate the cost related to those revenue streams so that someone is able to assess which part of your business is profitable, and if you're going to be driving revenue, what should you be focusing on mainly. So that's the one thing. The one element is now looking at the cash flow projection from your operational cost and how that is going to be moving. This is where you start talking about rent, you start talking about operational costs such as labor, you also start talking about maintenance of equipment if you have any. And really here we are trying to see how realistic can you be. So a lot of people, they just thumb suck 100,000. They normally try to work with round numbers. That is a one red flag that your cash flow is probably thumb sucked if all your numbers are round. Obviously, costs are not going to be exactly round. And here you also want to consider the tax element of it. If you are going to have a revenue and you're going to be projecting that your business is going to be making a profit, ultimately you are expected to pay your tax to the receiver or to your tax authority, depending on what jurisdiction you're operating from. So you also need to make sure that your cash flow is also taking into consideration the cash flow and the timing of this cash flow arising from this tax implication. And you also need to know when this tax implication is going to go through. So for example, your operational costs are likely to be recurring every month, whereas your tax flows are most likely going to be flowing in three times at least per year, which will be your first provisional, second provisional, and your top-up payment, if any. So really those are the main key concept on a cash flow projection. So if you are getting a cash flow projection from a consultant that you've hired to do the cash flow projection for you, you should be able to interrogate that cash flow projection and see, am I able to see the revenue stream that my business has? Are my costs relating to that revenue stream correlating? And if they are correlating sharp, if they're not correlating, are you able to start interrogating and say, how come my revenue is growing at 10%, my cost is only growing, but my cost is only growing at 2%? Because that could be a clear indication of a flaw in your assumption. Also, do consider inflation is going to catch up. Employee salaries are likely to be adjusted at a percentage higher than inflation. So it doesn't mean that all your cost needs to go up with inflation. So really, what I'm trying to drive here is don't just outsource the cash flow projection, especially if it's going to be linked to funding, because if your cash flow projection is flawed, the bank is going to give you money on a flawed cash flow projection, but you might find yourself struggling to meet those cash flow commitments because your cash flow projection was flawed in the first place. And overall, some cash flow projection can go as far as taking into consideration the time value of money. This is really just taking the discount rate that you're likely to obtain funding it and taking all those cash flow projection over a number of years and discounting it today and trying to determine whether this project will be worthwhile or not. Again, a very, very big concept, very broad, and you need to do further details. And if you're going to get a cash flow projection prepared by someone, ensure that you set up an interview with that person, tell the person what your business does, tell the person what you envision your business to do in terms of growth strategies, tell your person in terms of your cost management strategy, and tell the person to consult you at any point in time so that you're guaranteed that you're getting a quality, cash flow projection. This is all we had from today's discussion. Go ahead and do your research. If you are going to get funding, make sure that you're comfortable with those numbers, and you're always welcome to ask a question in the comment below if I haven't really discussed the concept fully. Thank you so much for making time to be with us during this afternoon. I really, really appreciate your time, and if you haven't done so, please consider subscribing. We will be very glad to have you as part of our growing community. Thank you.